Hello guys, I'm going to be taking you for the beginners Forex trading introduction. Okay. Okay. Oisches Capital. Introduction to Forex trading. Wealth is a commitment to one idea over time. That's our motto. Okay. It is very important to know and identify the different types of traders who participate in the financial markets. And, who really is taking part when you are also trading and what's happening. Now, before I actually go to this, let me just quickly tell you, for those who don't know Forex, what Forex means. It basically means foreign exchange. Foreign exchange. It's an acronym for foreign exchange. So yeah, the two types of commercial trading are, we have retail trading. That's where we are classified as, we the small traders are the retail traders. That's where you and me belong. So retail traders make up the small percentage of the Forex population, and this is where you and I would be classified. Retail traders by themselves. Retail traders trade by themselves and generate enough profit to sustain their living. So it's just basically us, the small traders, who are trading for themselves and, try to make a living from trading. Then we have corporation trading. This is done by learned employed financial traders who trade the company's profit to widen their margin for additional inventories. So those are like big companies that you see, the big companies like Coca-Cola and the likes. These companies also trade their profits to widen their margin and inventories. Okay, so why trade Forex? Because I always get a lot of credit. A lot of people asking me why we should actually be trading Forex. Okay. The Forex market is the largest market in the world, with over 7 trillion US dollars generated or traded every day, every single day. We generate, the market generates that amount of money from whoever is placing a transaction. Might be the big banks, retail traders, top bureaucrats, hedge funds. Everything contributes to all that 7 trillion that's generated daily. And, out of that 7 trillion generated daily, how much would you need to actually change your life and live your dreams? It's definitely under 1%. You don't even need more than 1% to actually sustain your life for the whole entire time that you live on this earth. Okay, so these are the 4 main reasons why you should trade Forex, why I actually took into consideration trading Forex. So first, there's liquidity. What do we mean by liquidity? Forex is unlimited liquidity. There's also a very high degree of transparency where there is massive liquidity, such as Forex markets, where over 1 billion transactions are made daily. So this is just the Forex market liquidity. We're just talking about the amount of money or the volume of money generated every single day. Then there is leverage. What do we mean by leverage? So leverage is more like when the brokers, borrow you money to trade a small account. You can start to trade with as little as $100, whereas in the beginning you could actually you were actually required to start trading with over $100,000 because there was no leverage. So you cannot, place a small transaction because there wasn't leverage. So what now happens is leverage magnifies your profits significantly. When you're trading, you are able to open a large volume and, be able to actually generate a large volume of profit. And cost. Forex trading has no commissions. There's no commissions in Forex trading, although there's a transaction cost that you pay to the broker. It's more like when you open a trade, it starts in negative, but then they're charging you for actually opening up that transaction, depending with the volume that you open. But then it's something that's very small and insignificant. And convenience. Nothing really beats the convenience of trading when trading full-time. You can actually do this from the comfort of your home. You can do it in the afternoon, at night. You can trade any time of the day. And you can, just spend, few hours on the charts analyzing, and then you go back to whatever business you're doing, be it work, be it your family, friends, or whatever. So Forex really gives you a lot of time to do other things besides just trading. You don't have to be sitting on the charts all day looking at them. Okay, let's move on to the next slide. Forex trading sessions. The Forex markets operate 24 hours a day for 5 days a week. These are the foreign exchange markets. There are also markets, from what I trade, it's called volatility indices or synthetic indices. It's open 24/7. But then for the Forex trading, where you trade currency pairs and commodities and all that stuff, it's open 24 hours a day for 5 days a week. And there are 4 major trading sessions one can choose to participate in, although in some cases the opening and closing times vary as seasons change in some countries. The 4 major sessions are Sydney session, which starts at 10 p.m. to 7 a.m. GMT. Asian session, 11 p.m. to 8 a.m. GMT. London session, 7 a.m. to 4 p.m. GMT. And the New York session, 12 p.m. to 9 p.m. GMT. These are the sessions. I'll put up a video where I explain the sessions in details and all their times, in line with our Zimbabwean time. But these are the sessions. These are the Forex trading sessions. Okay, let me just quickly speak about the recommended times to trade. In these time zones, the sessions that I've been talking about, they sometimes differ, especially on the New York session. When it's summer or winter, the times kind of change depending with if it's summer or winter. So I'll just give you a detailed explanation of this in the next session. Okay. So the recommended times to trade. This is during overlapping sessions. The session overlap, I mean to say, that time when, let's say, New York session ends getting into Asian session, or let's say London session ends getting into New York session. That's what we call the overlapping sessions. The London session is the busiest session of all the three. And this is where I mostly trade. If I'm trading currencies, I mostly trade during the London session and sometimes during the New York session as well. I never trade during the Asian session. Tuesdays to Thursdays, there's a lot of activity expected in the market during these days. Usually on Mondays, there's not much activity in the market because, you know, people are just getting off the weekend and, you know, they're just trying to get back on their feet. But then there are some movements in the market at times, and, you know, the market just trying to create the low of the week or high of the week. So there's kind of a lot of manipulation during the first hours of the trading week. So I don't really, you know, like to trade on Mondays. Then the not so good days to trade, Sundays. Market opens Sunday evening just before midnight. And everyone is sleeping around that time or enjoying their weekend. So there's not actually, you know, much activity going in the markets, much activity going on in the markets. Then we have Fridays, holidays, and major news events. If you are actually a beginner, major news events may not be good times to trade because you do not really know what's happening in the market, and, you know, there might just be a spike and you're surprised seeing the spike coming from nowhere and you're like, yo, Forex is a scam. But actually what's happening is there's what you call it, there is news. But even though they are recommended days to trade, you still find traders making money on the non-recommended days. It all depends on your trading style and, you know, what you're seeing in the market. Because sometimes opportunities are actually presented during those times when you say it's not recommended to trade. Okay. So we go to the types of trading. There are two types of analysis when trading Forex. We have the fundamental analysis and the technical analysis. Fundamental analysis is when you analyze a market through the strength of its economy. For example, the yen gets stronger because the Japanese economy is getting stronger. Technical analysis is when you analyze price movements on the charts. Technical analysis helps us identify trends which can help us find profitable trading opportunities. You must always incorporate both types of analysis to be a successful trader. So these are just the two types of analysis that we use in Forex. But then when you combine the two to actually, you know, come up with your trades and make your trades, it really gives you an advantage, because then you are entering the market when, you know, price has reached a certain point and there is maybe a news event or something. So then it really just speeds up the process of you making profit. Or if the market is going against you, it speeds up the process of you making a loss. So you have to really know what you're doing when you're trading this way. Okay. Before we actually go to the types of charts, I really want to speak about the top players in the Forex markets. Who are the top players in the Forex markets? We do have the big banks, hedge funds. We have the top bureaucrats. We have large corporations. All those guys are like really big players in the Forex markets. Let me just quickly tell you about them. Let's go to this. There's a page I'm trying to open. Okay. Share. Wait. Okay, my Microsoft Edge is not responding. It's not responding. Okay, let's just go to the types of trading. I'll present what I wanted to present in the next lesson, where I talk about the big banks and top players in the markets and what the banks do and how they manipulate the markets to get volume and induce traders to take positions so that they can get volume and move their big transactions. But for now, let's talk about the types of trading. Oh, we did talk about this. I mean, types of charts. There's 3 types of charts that we'll talk about. We have the line chart, the bar chart, and the candlestick chart. A line chart is the most basic type of financial charts. The line chart draws a line from one closing price point to the next closing price point. This is an example of a line chart. This is what a line chart is. I hope you are taking notes of what I'm presenting over here. Then we have the bar charts. Bar chart shows opening and closing prices as well as the highs and the lows. The bottom of the vertical bar indicates the lowest traded price for the time period, and the top bar indicates the highest price. The horizontal dash on the left side of the bar is the opening price, and the right side is the closing price. So this is the bar chart. This is just a small example of what the bar chart is. So this is where the bar opens and it moves. This is the high, this is the close, this is the low. Let me check. Yeah, this is how the bar chart looks like. That's how the bar chart looks like. I hope you are understanding this. If you have any questions, you can text me, then I'll explain to you what everything I'm talking to you about really means where you don't understand. Okay, then now we have the candlestick charts. This is the normal charts that we use. Okay, the candlestick charts expand on the bar chart, and it's by far the most popular chart. Candlesticks still show the high, low range and open close. The candlestick body indicates the range between the open and the closing price. All right. So we'll just do a lesson on candlesticks alone. I'll give you a candlestick Bible where you study candlesticks and their meanings and how we apply these candlestick patterns into our daily trading, because these candlesticks are very, very important in trading. This is one of the most important things in trading. You should be able to understand what every candle means and what it's trying to show you when you look at the chart. So this is the basic type candlestick. We have the real body. This is the real body. Then this is the upper shadow or wick. This line, yeah, it's the upper shadow or wick. Call it the upper shadow or wick. Let me just annotate. Doesn't want me to annotate. Okay, it's the upper shadow or wick. Then this is the lower shadow or wick. Then this is the open. This is the open, yeah, at the bottom, and this is the close at the top. Then yeah, there's the open and there's the close. So now you might be confused why the other one is opening at the bottom and why the other one is closing at the bottom. So we have two types of candles. We have the bullish candle, which is normally colored green, and then we have the bearish candle, which is normally colored red. So in the markets, we have the bulls and the bears. Even when we speak about the trends, we have the bullish trend and we have the bearish trend. So now this candle, which opens at the bottom and closes at the top, this body is usually green, and this is what we call the bullish candle. And this one here, the black candle, usually colored red. It all depends on what colors you want on your charts, is the bearish candle. And the price opens here at the top and closes at the bottom because the candlestick is moving, going down. So this is the candlestick. Let me show you what the candlestick chart looks like. Okay, so this is what the candlestick chart looks like. The green candles, these are the bullish candles, and the red candles, these are the bearish candles. For example, this bullish candle, it opened over here. Let me try to annotate. So it opened over here. Then we have our wick, the bottom wick. Then it closed over here. This was the high. This wick was the low, and it closed over here. That's the bullish candle. Then the bearish candle, this bearish candle, it opened over here. This was the high, this was the low, and it closed over here. So this is our candlestick chart. I hope you understand this. Moving on to the next segment, which is candlesticks. Candlesticks are formed using the open, high, low, close. The candlestick's colored section is called the body. The long, thin lines above and below the body represent the high and the low range and are called shadows, wicks, or tails. Candlestick Bible will be provided for an in-depth study of candlesticks. So I'll provide you with the Candlestick Bible just after you've went through this session, and I'll give you the Candlestick Bible. Then we can discuss on the candles, and I'll give you guys homework. Trading styles and time frames. There are 9 standard time frames, and all of them tell different sides of the story. Each time frame speaks to every trading style. The most important function of time frame is to depict the movement of price as market flows. The 9 time frames in order are the 1-minute time frame, the 5-minute time frame, the 15-minute time frame, the 30-minute time frame, the 1-hour time frame, 4-hour time frame, daily time frame, weekly time frame, and monthly time frame. Every candlestick in a time frame represents that session of that time frame. That means if you are on the 1-hour chart, every candlestick represents 1 hour. And if you have opened daily time frame, every candlestick represents 1 day. Okay. I'm not sure if you guys understand this. So let me just quickly annotate what I'm talking about. So let's say this is the daily time frame. Daily time frame, D1. So this is our candlestick. Yeah, open, close, whatever. Let's say we have our candlesticks. Call them the bars. So on the daily time frame, this candlestick, this one candlestick represents 1 day. This candlestick represents 1 day. This candlestick represents 1 day. So on the daily time frame, this would be 3 days. So what happens is this candle runs for 24 hours. It opens here, This is the low, this is the high, and it closes, yeah. And it's open for 24 hours. Then after these 24 hours, the next candle opens, which is this one. It runs for, again, another 24 hours. And we have this one as well. This is if it's the daily time frame. It's the same if it's the minute 5 time frame, or if it's the 1 hour time frame. So if the 1 hour time frame, this candle will represent 1 hour. So it runs for 60 minutes. Same as this candle, same as this candle. Let me just try to see if I can show you a practical example on the chart. New share, Dave, share. I hope you can see my screen. So this is the 4 hour chart. Okay, let's go. This is the 4 hour. It's being slow. This is the 4 hour chart, and every candle on this chart represents 4 hours. This is 4 hours, 4 hours, 4 hours, 4 hours. This is the 1 hour chart of the same chart I've been showing you. So, you know, each candle represents 1 hour, 1 hour, 1 hour, 1 hour. So it's all 1 hour. Yeah. And in a day, we should have 24 candles, 24 1 hour candles. Yeah. So you do the maths for the 30-minute candle to see how many there will be. Okay, back to our presentation. Trading styles and time frames. We have a few trading styles that we have, which we're going to speak about. We have scalping. Scalping requires quick execution and tactic. And the time frame to trade this style is 1 minute, 5 minutes, 15 minutes, and 30 minutes. We have intraday trading. This is the style used by traders who open positions that are to be closed before the day ends. So intraday, it's within that day. The recommended time frames for this style is 1 hour and 30-minute time frame. Position trading is done by traders who want to hold their position for more than a day, and the recommended time frames for this style of trading is monthly, weekly, and daily. We can also use the 4 hour for this. We usually call it swing trading. And the above just remain suggestions based on my trading experience. This here really just shows how the market moves. We have our support and resistance, impulsive moves. That's what I'll explain it in detail in the next slide. So we talk about support and resistance, trend lines and channels. Support and resistance. Support and resistance is one of the most widely used concepts in trading. Support and resistance depicts the price levels in which the market constantly fall or rise and eventually reverses. Trend lines will assist you to detect the level of support and resistance. Okay, so this is a practical example where we talk about our support and resistance. So support, this is a zone where the market comes and tests, and price moves away from that zone and comes back and tests that zone, respects that zone, and moves away again from that same zone. So let me show you here. This is our support, strong support. So price came here, it tasted, let me just change the color. Change the color. Okay. So price came and tested this zone. It went back up. It never came down and broke this zone. It tested this zone again, and it went back up. This makes this a strong support zone. And the resistance zone is and price is resisting to, you know, to break a zone going to the upside. So it comes here, it tested, didn't break, went down, it tested, it eventually broke. That's why it's a minor resistance. But yes, so the support zone is a zone that supports price. It's a zone that supports price. It's more like price is coming and respecting that zone and going back up. And the resistance zone is where price goes up and hits that zone and it respects that zone. It doesn't break that zone, goes back down, and keeps respecting that zone. This is a resistance zone. Price came here, it respected, it went down, went back up, respected the zone, went down, went back up, respected the zone, went down. Then it came here and broke this zone. So once a resistance zone is broken and price comes back and tests this zone from the upside, it then becomes a support zone. And the opposite is true for the resistance. Once a for the support, once a support line is broken and price comes back to retest, it becomes a resistance zone. I'll explain this further in the next coming sessions. So this is basically the support and the resistance. Trend lines are one of the most common form of technical analysis used today. They are drawn under price lows or beyond the price highs. So these are trend lines. So there's an uptrend showing us trend lines. There's a downtrend, uptrend, downtrend, uptrend. Then there's a sideways trend, downtrend. I'll show you an in-depth example of trend lines in the next lesson, and how to excuse me, and how to draw these trend lines. If we take a trend line and draw a parallel line at the same angle of the uptrend or downtrend, we would have created a channel. When price hits the bottom trend line, this is usually as a buying area, used as a buying area, and when it hits the upper trend line, it's used as a selling area. Okay, so there's a channel. There's a bullish channel. Price hits the bottom, it buys. It's the bottom, it buys. There's a bearish channel. Price hits the top, sells. It's the top, sells, buys when it hits the bottom. These are basically what we call channels, and we'll do an in-depth study of this in the next coming sessions. And I think that's the end of the lesson today. I'll upload this video on YouTube. Make sure you take notes, like, and subscribe. Thank you very much.